Welcome to the deep dive. Today we're diving into a financial topic that honestly often triggers alarm bells, the
Uh,
credit card.
oh, yeah. Definitely one people have strong feelings about.
Right. Now, you've probably been inundated with warnings, told it's a trap, maybe a one-way ticket to debt, something to be avoided, like at all costs.
Absolutely. That narrative is everywhere.
But what if that widely accepted story is actually, well, incomplete? We're taking a deep dive into some really thought-provoking excerpts. They're titled Credit Card, Tool for Wealth, Not Debt.
Intriguing title.
Isn't it?
Yeah.
So our mission today is to fundamentally challenge that common perception. We want to reveal how this often demonized financial instrument can, maybe with the right strategic approach, become a powerful tool for building wealth, not ruin.
And that negative perception is incredibly prevalent.
Mm.
It's understandable, too. I mean, given the struggles so many people genuinely face with credit card debt.
For sure.
However, this source we're looking at, it suggests that this fear often stems from maybe a fundamental misunderstanding of the tool itself, not necessarily an inherent flaw in its design.
Okay.
There's potentially a much deeper, more strategic truth to uncover here.
Okay, let's unpack this then. The mainstream narrative, it's incredibly strong. Like you said, credit cards are demonized by, well, frankly, almost everyone. You hear it from financial news, cautionary tales, maybe from parents, even, well-meaning but maybe struggling friends. They all warn you.
It's the default advice almost.
It really is. They label it a trap, insist it leads straight to debt. And let's be honest, for a lot of people, that warning holds true. It does happen.
Sadly, yes.
That's because, as our source rather bluntly puts it, those individuals are using it wrong.
Okay, using it wrong. How so?
Well, they're not aligning their spending with what they can actually afford. They're often attempting to finance what the source calls a lifestyle that's a lie. Projecting affluence they haven't genuinely built.
Keeping up appearances.
Exactly. This chase for instant gratification, but without the discipline to back it up, the source labels that a fool's game.
Harsh, but probably true in many cases.
And it says it ultimately leads to being a slave to the banks, a slave to your own weak impulses. Strong words.
Very strong. And it makes sense why that perception is so ingrained. That impulse for immediate gratification, it's a huge psychological driver, isn't it?
Definitely.
And that's precisely why the negative association with credit cards is so deep for many. People link them directly to impulsive spending and, well, the resulting financial pain.
Makes sense.
However, the source makes a really crucial pivot here. It argues that a credit card isn't actually a debt tool at all, if used correctly.
Okay, that's the key qualifier.
Right. Instead, it frames it as a leverage tool. It presents it as a key to a different financial reality, like shifting from just being a passive consumer to becoming an active financial strategist.
Okay, here's where it gets really interesting for me and probably a bit counterintuitive for a lot of listeners.
Go on.
The core trick that the source reveals, it's deceptively simple.
Okay.
You only use your credit card for things you can already pay for with cash right now.
The golden rule.
Yeah.
Pay it off immediately, essentially.
Exactly. This is the critical distinction, the non-negotiable rule. You're not using it to buy that shiny new gadget you can't quite afford yet.
Right. No financing desire.
No, you're using it for your groceries, your gas, maybe your utility bills, all those essential expenses you'd be paying for anyway. Right. Regardless of how you pay.
Okay.
It's about channeling existing planned spending through the card, not creating new spending.
And that's precisely where that concept of leverage really comes into play.
Yeah.
Think about it.
Yeah.
When you use cash or even a debit card, you're just moving money around, as the source puts it. It kind of suggests you're just a pawn in the game. Your money's gone instantly.
Yeah, it's just spent.
But a credit card is different. The source calls it a statement of trust from the bank. It signifies they trust your ability to repay.
Interesting way to frame it.
And when you have that trust, you're essentially using their capital for a short period, typically that interest-free grace period.
Right, between statement and due date.
Exactly. Meanwhile, your own funds remain liquid. Maybe they're sitting in a high-yield savings account earning a tiny bit of interest, or just available for immediate opportunities or emergencies.
Okay, I see. So you're floating the payment with the bank's money temporarily.
Precisely. That's a crucial, often overlooked benefit for someone who's financially savvy. You're optimizing cash flow, even on a small scale.
Exactly. Because every time you follow that simple rule, every single time you use your credit card for something you already have the cash set aside for, you're potentially getting a return.
the rewards piece.
Yes. Whether that's cashback, travel miles, points, whatever it is your card offers, you are effectively optimizing your routine spending to generate these tangible financial returns.
Whereas with a debit card,
With a debit card, the average person gets, well, zero back, as the source says. Zip, nada. But with the credit card strategy, you're getting a small percentage back on potentially every dollar you spend responsibly.
and it adds up.
It's not about the tiny amount on each individual purchase, is it? It's about the powerful cumulative effect. It's about being a little bit smarter, a little bit more strategic with every transaction over months, over years.
Right. It becomes a habit that pays dividends, literally. And what's fascinating here is how this strategic, disciplined use, it naturally transitions into building something much bigger.
Okay, like what?
Well, beyond the immediate rewards, points, cashback, whatever, a credit card used this way is described as a powerful tool for building your credit score.
The credit score, yes.
And the source stresses this isn't just a number. It's essentially your financial reputation.
Your financial handshake, almost.
Exactly. It's the primary way the financial world assesses your trustworthiness and your stability.
Yeah.
It signals how reliable you are with borrowed money.
And the implications of having a good credit score for you, the listener, they're huge, aren't they?
Massive.
The source says it allows you to get a loan for a business, a mortgage for a property, or favorable terms on a car. Better interest rates, basically.
Which saves you a lot of money over time.
A ton of money. Our source emphasizes that a good score gives you options. It gives you real leverage in negotiations for loans and things, and it literally opens doors that are locked to the average person. It changes your entire financial landscape.
It really can. It moves you from being potentially constrained by finances to having more control and opportunity.
But okay, beating that reputation, building that score, it isn't just about having the card, is it? It's about how you use it. What are the key behaviors the source implies are needed to really leverage this tool without falling back into those old debt traps?
That's a crucial point, absolutely. Because simply having a credit card isn't the magic bullet. Disciplined behavior is paramount. The source strongly implies several non-negotiables.
Like when?
First and foremost, and this echoes your earlier point, always paying your statement balance in full. Every single month. No exceptions.
Got it. Avoid interest like the plague.
Exactly. Because interest charges would completely negate all your rewards and the whole concept of leverage. It defeats the purpose. Second, it's about keeping your credit utilization low. Meaning, don't use more than a small percentage of your available credit limit, even if you do pay it off in full each month. Maybe keep it under 30%, ideally even lower, like under 10%.
Why is that important?
It signals to lenders that you're not reliant on credit, that you have financial breathing room. Maxing out cards, even if paid off, can look risky.
Okay, low utilization. What else?
Third, consistent on-time payments are fundamental, like absolutely basic but critical. This builds a strong payment history, which is the single most significant factor in your credit score. One late payment can hurt you.
Right. Automation can help there, maybe.
Definitely. Auto pay for the minimum or statement balance can be a safety net. And finally, though maybe less explicit in this source, selecting the right type of card for your spending habits seems implied.
Matching the rewards to your life.
Yeah, whether it's travel rewards if you travel, cashback for simplicity, or specific category bonuses like groceries or gas, that's another layer of strategic optimization to maximize your returns for your lifestyle.
So when you put all that together, the central argument really seems to be that the problem isn't the card itself, the physical piece of plastic.
No, not at all.
It's the mindset of the person holding it.
Precisely. It's about the user, not the tool.
And the source doesn't just say, stop seeing it as a danger. It urges you to start seeing it as a weapon, which is pretty intense language.
It is a weapon to build your financial empire.
A financial empire. It sounds almost grand. But the idea is empowerment, right? Taking proactive control instead of being controlled by debt.
Exactly. It implies that mastering this one, often feared tool, gives you strategic control, not just over small daily purchases, but it builds the foundation, that credit score, which influences your broader financial trajectory.
Which then allows for bigger moves later on.
Right. Securing capital for investments, getting those favorable terms on major assets like a house. That's what truly allows you to build a personal financial empire, however you define that for yourself.
So the message from this deep dive, the challenge to the listener, it seems loud and clear. You have a choice. You can follow the common narrative of fear. Or you can choose to be the one who uses it as a tool for wealth, not a path to ruin. Be smart, be strategic, and Start stacking those points or miles or cash back. Start maximizing those benefits.
Turning everyday spending into a small, consistent financial advantage.
So there you have it. What many of us, maybe myself included sometimes, have been warned about as a potential debt trap, the credit card can actually be transformed
Yeah, completely reframed.
into a potentially powerful wealth-building tool. But it takes that simple, disciplined approach and, maybe most importantly, a fundamental shift in mindset.
It really does. And, this whole discussion raises an important question, I think, for you to consider.
Oh, what's that?
Well, if a tool like a credit card, something so often misunderstood and, frankly, feared,
Mm-hmm.
if that can be transformed from a perceived danger into a significant advantage just through a shift in mindset and strategy,
Yeah.
then what other seemingly ordinary financial instruments or even just daily habits might be secretly holding untapped potential for you? What else are we maybe looking at the wrong way?